Welcome back to What's Hot, What's Not, CRE, your daily pulse on commercial real estate in America. It's Friday, January 30th, 2026. Today we're tracking where institutional capital is flowing and where it's staying away, and the big picture for 2026 looks optimistic. Overall, CRE investment activity is expected to jump a healthy 16% this year, touching around $562 billion. That's a number that gets us tantalizingly close to pre-pandemic levels. But the real story isn't just the volume, it's where that money is laser-focused. So, what's hot? Unquestionably, data centers are dominating the conversation and the capital inflows. The demand is absolutely explosive. We're looking at a projected $602 billion in AI infrastructure investment for 2026 alone. To put that in perspective, that's a 36% leap from 2025. The institutional players are all in. Just look at Blackstone. They reported a staggering $71.5 billion of inflows in the fourth quarter of 2025 alone, focusing heavily on digital and energy infrastructure. This isn't a blip. The data center sector is growing at a 14% compound annual growth rate, which is projected to create $1.2 trillion in real estate asset value over the next 5 years. Trillion, with a T.
Right behind data centers, industrial still has major momentum. Why? Supply. It's down a whopping 70% from the pandemic peak. This means we're forecasting vacancies to tighten significantly in late 2026, giving landlords some serious pricing power. And let's not forget multifamily workforce housing. In a market hungry for certainty, the stable cash flows from this asset class are incredibly attractive to income-focused capital. Now for what's not. What's getting the cold shoulder? Well, no surprise here. Smart money is still avoiding older office assets. The performance gap between prime, amenity-rich buildings and secondary, dated properties is widening into a chasm. Also on the avoid list for many investors is Class A multifamily, but specifically in those oversupplied Sunbelt zones. Don't let the concessions mask the fundamentals. Investors are steering clear of any asset without a clear, believable path to stable occupancy. A telling sign of this caution is in the CMBS market, where activity is largely driven by refinancings, not new acquisitions. It shows a market focused on managing existing risk, rather than taking on new ventures in these weaker sectors. So, where exactly is that smart money targeting? Geographically, it's a two-pronged approach: high cash flow Midwest cities and the reliable, fast-growing Sunbelt metros. Think Dallas-Fort Worth, Nashville, Charlotte. And increasingly, secondary markets are gaining institutional interest for their resilient fundamentals and more attractive pricing. In terms of property types, the priority list is clear: data centers, industrial logistics, multifamily workforce housing, and select build-to-rent communities. The common thread here? Recurring income, stable occupancy, and operational quality. That's the mantra for 2026. Why does all this matter? Because this capital rotation is real. Money is actively moving away from speculative growth plays and toward defensible, income-producing assets. As institutional and cross-border capital returns to the market, we expect a 15 to 20% increase in sales activity. That increased competition will likely cause cap rates to compress by 5 to 15 basis points. Asset selection and management are now critical. Income-driven returns are the story of 2026. So here's your investor takeaway. The 2026 Capital Playbook. Follow the smart money into data centers, industrial, and workforce housing. Target Midwest cash flow and Sunbelt growth markets. Avoid older office and oversupplied Class A multifamily. This is an income-driven year. Asset selection matters more than ever. That wraps up the week. Have a great weekend. Don't forget to like, share, and subscribe. Visit hotnotcre.com to learn more and subscribe to our newsletter.